Hello there. Good morning, everybody. Good evening, wherever you are. Welcome into the Everyday Growth Advisors live stream, the webinar you have been all waiting for in this year. I hope you guys are having a good day. My name is Tushall Sharma. I will be your host for today. Welcome, welcome, welcome. Nice to see all of you here. The link you sent, my email's broken. I had to go to your IG to get the link instead. Okay, we will have our team work on that. I'll make sure that the link that is sent out will work properly. But in the meantime, welcome into the biggest webinar event that we have this year, the 2022 market forecast, which is going to be a 1-hour event today. I am your founder. I will be leading this event today, and let's not waste any time and jump right in, right? A little bit about me, what you should know about me, things that you should know about me, and why I do the things that I do. I'm the CEO and founder of EGA, which is Everyday Growth Advisors, and we pretty much are a investing and trading education school. We offer mentorship programs, and I have about 9 years of investing experience and trading experience. I've been through one financial crash, as majority of you that know me know this about me. And I recently graduated with honors from St. Mary's College in Northern California with my master's in finance. And I'm currently pursuing my CFA level 1, which I hope to get sometime next year. I currently manage a hybrid stock and options portfolio. And last year's profits were roughly about 220,000, including my drawdowns from China, which is an interesting topic, which we will cover on a separate day, right? I think one of the things that stands out about our investing style at EGA is that for the past 5 years, we have consistently beat the S&P 500 using a personal style of value momentum investing, and we teach other people how to do this as well. So a lot of the information that we're going to be putting out today is all available to you guys for the free, and I hope that you enjoy what we've put together for you guys. We've taken a lot of time to do this, and I think it's very beneficial for most of you to listen in and just take in and be objective. So let's get started with the agenda today. I hope to cover all of this in under 1 hour. As well as at the end, we have a special announcement for our courses. So make sure that you stick around. For those of you that have been wanting to join us and you don't quite know how, or you don't quite know where to start, this is the perfect webinar for you to get everything you need so that you can actually make your starting point in your trading or your investing journey. All right. So we're going to be going over first the U.S. market performance of 2021. We're going to recap what happened. How did we do? What were the best performing sectors, right? Then we're going to talk shortly about the Fed and the balance of their balance sheet. How is the Fed going to balance monetary policy this year or the year beyond? And then we also want to look back at some lessons from 2021. What could we have done better? What are some things that were glaring mistakes that investors made in 2021? Especially since in 2020, since the COVID crash happened, there has been a turbocharge of new traders and influx of new traders that have joined the stock market, right? A lot of people had a lot of time on their hands and they joined looking for something to do, and trading became one of those things. So what are some lessons of people that stumbled and fell last year, and then also what to look forward to in 2022, right? This is why you are all here today, right? So what are some of the best practices for 2022? What are some updates on valuations? And what are the secular trends that will continue into 2022? These will be important, right? I think they're all relevant. And then we're also going to cover as I promised, common mistakes that traders make who have just started, right? And how do you avoid them, right? I'm going to briefly talk about the mistakes and how do you avoid them. So we'll talk about 5 mistakes that beginner traders make when just starting off. Great. Well, if you can all hear me, put a little heart or another emoji in the chat so that I know I love talking to you guys, and I've missed this. I miss being on the live streams and webinars. Haven't done it in a while, and just a lot of things take up my time nowadays, and I really truly miss this. So it's nice to hear from you guys in the chat. I appreciate you taking your time out, being here, and just sending me your love. I appreciate it. Also, if you haven't yet, make sure you smash the like button. That really does help us get this stream out into the greater, YouTube realm. Of course, we want as many people to watch this webinar as possible so that everybody can be educated for free, right? Okay. Excellent. So let's get started here. I don't want to take too much time away from the actual event. Let's talk about the US market performance. Okay. So we had a pretty decent year. The S&P 500 delivered double-digit growth again, right? 2 years consistently. And this has been something that, I think we all have been not exactly shocked, but we weren't really expecting double-digit growth for both years. In fact, my forecast from last year's webinar was to see mid to high digit growth, double-digit growth, right? I was expecting something more towards the 10 to 20% growth, and we exceeded expectations this year, and there are a couple of reasons why that happened, right? This year, obviously, coming to it later, we have different expectations. And we have had a series of events that have happened that absolutely changed the trajectory of the expectations of the stock market, right? So the current S&P 500 PE ratio as of today is 25.09, right? If you remember a couple of webinars ago, maybe 1 or 2 webinars ago, this was at 40 plus PE ratio, right? The S&P 500 PE ratio was at 40 plus, and I had spoken about this a while back, saying, valuations are starting to get stretched. Of course, there are still companies that within the S&P 500 are absolutely not overvalued, but there are some that are extremely overvalued, right? And we kept talking about how these high beta stocks have been consistently chugging along in terms of valuations, and investors have been really overly exuberant about all the high beta stocks, right? In comparison, you can see that the mean of the S&P 500 PE ratio is around 16, the median is around 15, and the max was in May 2009, right? So here is the stock market report, and you can see the distribution of returns. Of course, we are up in the stock market 75% of the time. The downsides are 25% of the time. So the distribution, the probabilistic distribution of performance of the S&P 500 delivers more upside returns than downside returns. And this is the reason why I always tell our students, our mentees, if you don't want to pick stocks and you don't want to be somebody who is constantly trying to pick the right one, just buy the damn index, right? Just buy the damn index, right? You don't need to pick stocks to be successful. In fact, I will show you later that stock picking, even by the professionals, can go wrong. Okay, even by the professionals. So, what were the best performing sectors of last year? Now, let's talk about that real quick. Let's get the year-to-date performance, right? And you can see that energy, financials, real estate, technology, these were really, really dominating returns, right? Also, communications, right, did much better than expected. Usually muted returns, but this year was good. And then, of course, healthcare performed better than expected, right? A lot of the S&P 500 sectors delivered very strong returns, very, very strong returns, right? And we spoke about energy. I've been bullish on energy for almost 2 years since the COVID crisis happened, right? For obvious reasons. We spoke about OPEC, OPEC Plus, we spoke about Russia. I've multiple times repeated myself about how that dynamic works and why I continue to be bullish on energy and oil exploration, right? And of course, I'm gonna further personify this point forward going into this webinar, right? But it's important to look at where we, came from this last year and where we are now. In the first month of the stock market in this year, things have corrected aggressively. In fact, this is probably one of the most aggressive corrections I've seen just starting off the year, right? There was no personified Santa Claus rally, and instead, the timing of the Fed kind of made this into a very close quarter instance in which the stock market took very interesting moves within the first few weeks of the year, right? And as the saying goes, and I like to always say, when the bond market sneezes, the whole equity market catches a cold, right? And so that has been really the main explanation here for the first 1 month of the year, right? So looking at the Fed's balance sheet, let's get into some of the tasty material here, right? This is what mainly has been on center focus, right? Center focus, this is what the headlines have been telling you about. It has every single person on TikTok, every single person on YouTube, every single person on, every single social media platform is only talking about the fact that the Fed is, going to taper interest rates, and that is what is causing this whole market to shift, right? But many people realize it's not just about the interest rates, guys. Okay, yes, it is. The interest rate is a effect. You need to understand that. The interest rate is a effect because the real action that is happening is a reorientation of the credit market. Okay, it is a reorientation of the credit market. So many people don't understand this because it's too complicated. So how do they oversimplify it? They just talk about the Fed increasing interest rates, which causes technology stocks to go down, or stocks, equities in general to go down, right? But you have to realize, surely you have to realize what is going on here. This is not a equity problem. This is a bond market problem, okay? And we are looking at credit cycles that are resetting themselves after a year of extreme liberation, okay? So let's take a step back here. And once again, if you're just joining the webinar, welcome in. I appreciate you guys being here. Once again, if you haven't yet, smash the like button so we can get more people on here. We want everybody to learn as much as possible. And I truly appreciate you guys hitting the like button. It helps me out tremendously. So let's go back here, take a couple of steps back here, and let's look at this, right? So how does this all work? How does this all go down, right? I'm going to take about 5 minutes or so to explain this so that everybody can be on board with this, right? So you have to realize something. The credit market works in a very intricate system, right? First of all, the Fed doesn't determine what interest rates are directly, right? It does it through something called the Federal Open Market Operations, right? And what this does is they influence interest rates in a target range by buying and selling bonds, all right? Now, bond prices and interest rates have inverse relationships. As I have, given you a figure right here for you to kind of visualize it, right? When bond prices are higher, interest rates fall, which is what is happening now. But in 2020 to 2021, we had interest rates that were going up, and we have bond prices falling. Sorry, it's the reverse of what I just said. I got it the other way around. But you know exactly what I'm talking about, right? This is actually this way around. Sorry. Let me just redraw that real quick. So interest rates rising, bond prices are falling right now. And 2020 to 2021 was here. Sorry, I meant to do it this way. There we go. Now, why did this happen in the past? It was very simple, right? We had a lot of chokes in the economy. The COVID crisis caused a lot of uncertainty within our markets, right? And the liquidity that was provided were provided mainly to alleviate those chokes. The Fed was very accommodative with monetary policy, and during this time, it was a lot of bonds being taken on the balance sheet. So you can see this over here is the Fed's balance sheet. Okay. Now, what does the Fed's balance sheet consist of? It consists mainly of bonds, right? And how does the Fed inject money into the economy? They will buy bonds, okay? They will buy bonds. And when they buy bonds, that's how they are going to inject money into the economy, all right? So this is a very basic understanding of how that intricate system works. Now, remember that bonds are also a store of value. They're also a store of simple interest. People tend to absolutely store money in store value in bonds from time to time, and when they do so, the returns are usually very, very low. Right? Bonds are not a very good place to put your money. Majority of people know this, right? And the reason why it's not a good place to put money is because there are other better pockets of financial markets where you can get higher returns, right? Now, when the bond prices were rising, right, and we were seeing a lot of last year and the year before play out during the COVID crisis, we had a lot of money that was willing to take risk. Okay, it was willing to take risk. And this risk-taking pockets of the market ended up spilling over into equity markets, right? Now, there are two dynamics here. The two dynamics are, first things people take risk on. The second thing is they tend to over-leverage, right? They tend to over-leverage. And over-leveraging can be a good thing or a bad thing if the returns are superior, right? But what happens when everybody over-leverages at the same time? That causes somewhat of a shift in the market, okay? Now, it is after this happened that the prices of everything started to rise, right? Not to mention, adding to this dynamic, we had supply and demand chokes that were adding to this. A lot of demand was pent up, and there was very little supply. So increase in demand and supply staying the same or lowering causes prices to rise, right? This is simple supply and demand dynamics that you learn in school, right? Now, when prices rise, what does that cause? Inflation, right? And this is exactly what the Fed is dealing with now. This is what people saw coming from last year, and we spoke about this last year, that inflation wouldn't be such a terrible problem because it would be transitory, right? But because inflation is transitory, the Fed has very little tools to deal with this. And one of the ways that it deals with this is by selling bonds, right? It's quantitative tightening, which they haven't quite done yet, by the way. Okay, they haven't quite done yet. They're thinking of doing it, so the stock market is already pricing in that action, right? Remember, I always tell you guys, the stock market prices in things 6 to 8 months before it happens, right? And so now that the bond market is starting to realize, okay, we're going to be expecting inflation to drive interest rates up, this is the real shift, okay? Now, the other thing about why equity valuations, like for example, why does it affect technology stocks? It's mainly because a lot of valuations are driven by algo models nowadays, right? How many of you actually think, just a poll, right, and a show of hands, how many of you actually think that, there are people sitting behind these desks at JP Morgan and Goldman Sachs hitting the button trading? Now, I can tell you that there are very few of those traders that remain nowadays, right? A lot of what is done in the stock market is now automated. In fact, I saw an article saying that almost 75 to 70% of all trading is, just done automatically through an algo system, right? And a lot of these algo models, they have valuations built in, right? They're plugged into the model. So what happens is, whenever any news is released or something sensitive is released, immediately there is a shift in valuations for all equities. And those models, they cascade down signals to sell or buy, okay? So this is all automated now. And this is important to note. So what does the Fed do now? They have signaled 3 rate hikes, okay, with the possibility of a 4th one, okay. And the stock market in this past 1 month has overreacted to the situation, extremely overreacted, right? Because ask yourself a question, even if some of these companies have a revaluation, would it make sense for, if interest rates go up by a small percentage, that some of these really good stocks are down by almost 50%? It doesn't make sense, obviously, right? But does that mean you go into the market and you start picking up every stock that you can get your hands on? Absolutely not, right? So the Fed has to balance this by accommodating monetary policy and at the same time controlling the fiscal spending. Now, they don't have effects on fiscal spending, so what that does is it puts a budgetary constraint on the Treasury and the government, right? One thing good about high inflation, though, is that it naturally reduces the debt of the nation, right? Think about it this way. When inflation rise, the cost of goods and services rise, right? And what is the biggest way that the government's income is? It is taxation, right? Taxation. How does the government make money? Taxation, right? So by taxing, that's how the government's income is achieved, right? Of course, there are many other things, import, export, blah, 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 but we talk about the biggest income of the government is tax. And when the prices of goods and services increase, what happens to tax revenue? It increases as well. This allows them to actually pay down their debt more efficiently, okay? So inflation is actually a good thing for government debt, but is it a good thing for consumers? Probably not, right? And this is the reason why the Fed has a very delicate balance to act. Now, the Fed is going to have to increase interest rates, look at the effects of interest rates, and then taper or rebalance their interest rates. What we are expecting is we would see 3 to 4 rate hikes, a resurgence of what Fed Powell would do would be look at where things are in a year from now and then decide what they would do once again. Now, we are lucky to have a Fed that is generally pretty accommodative, right? And so this shouldn't be a big problem going forward in this next year. Is this an opportunity for you to buy the dip on the stock market? Absolutely, right? With no doubt, I can tell you that it is absolutely an opportunity. But what you buy is going to make or break your portfolio this year, okay? So that is what we're holding this webinar for. It's to guide you through that process. It's to make you understand that it's not just interest rates that are causing this problem. It is the bond market, it is the credit market. It is a lot more things than meets the eye that people oversimplify that many people don't get. And here I'm here to actually help you to understand those things from a more magnified lens, okay? So this huge balance sheet on the Fed needs to be offloaded in the years to come, right? And that is going to be done through them selling bonds. So what does the bond market do in advance of the Fed selling bonds? They go and sell bonds, right? Nobody wants to sell bonds at a cheaper price than the Fed. So everybody has been rushing to the hills to sell bonds. And what effect does that have? When bond prices fall, interest rates rise, okay? This is your cascading effect or a domino effect of what happens in the stock market. When these interest rates rise or the bond yield starts to rise, right? Bond yields start to rise, then this causes valuations to go down. And why does that happen? Because majority of valuations are reliant on the 10-year treasury. This is what we use to calculate something called the risk-free rate, which is assumed that the 10-year treasury is a risk-free asset that you can hold into perpetuity. The federal government will pay on the bond. Okay, it is almost like it's in finance we say it's risk-free. Okay. All right. So that's an update on the Fed's balance sheet. That's what's going on. And if you understood everything that I just said, or if you have any questions regarding to this topic of conversation, please drop it in the chat in the comment box, and I will address it later. Right? And if you do understand it and you like that explanation, then please let me know too, so that I can continue on with this. Okay, so let's look at some lessons from 2021. One of the biggest lessons was to not chase bad businesses and follow the crowd into the thick of it, right? For a long time, we spoke about how a lot of these businesses in the ARK fund have been over-levered, right? ARKK. The Innovation Fund was at a peak valuation sometime in 2021, right? in 2021 February, I believe the ARK fund was at its all-time high, right? Everybody was overly exuberant. And then we had the first dip, right? And then a lot of people buy the dip, and then another dip, and a lot of people tried to buy that dip, and then a phase of consolidation, and then ultimately a very big drop in this past couple of months, right? All of this mainly happened because all of these high beta stocks are even more sensitive to these valuations, right? They already tend to have very sensitive valuations, and then when you throw in the new interest rate hikes, it causes even more sensitivity to their valuations. So you will realize that a lot of the ARK K companies were companies that weren't actually making money. They were growth stocks, right? And don't get me wrong, I do have some of ARK K in my long-term portfolio, but it is not a big part of my portfolio, right? It's a small part of my portfolio because I like the risk that it can bring. But remember that with risk, you are going to be expecting volatility, right? And this is what you're seeing volatility, right? A big 50% drop from the highs is where we are at right now, almost, right? This chart is accurate to yesterday. This is one of the lessons from 2021 that you have to learn, right? That companies that don't make money, have to have a very small allocation in your portfolio. And in the short run, don't chase the high performance stocks or the hype stocks, right? In fact, how many of you, went really all in on ARK Fund in 2020 and 2021? How many of you did that, right? Expecting huge returns. It's always remember that the performance of the market is all relative, right? Which means to say there is always a rotation of money, a rotation of capital that allocates throughout pockets of the market, right? And what happens when things are extremely overvalued? They tend to go from overvaluation to undervaluation. And things that are undervalued, they tend to go from undervaluation to overvaluation. So how do we avoid these things? Well, here are some good practices, right? First of all, as I was mentioning earlier, remember that when there is peak fear in the market, like in situations like this, especially today and the weeks going forward where the market continues to sell off, these are all selling in panic moments, right? People are panicking. And when people panic, you need to step in to be the liquidity provider like a market maker, right? But it's important to not get this wrong, because you have to add only fundamentally strong businesses with good balance sheets, good economic moats, companies that are strong enough to withstand the environment, companies that will do well irregardless of what happens this year, right? I could care less if, there is a tsunami or if there is something else, if there is a financial crash. I know these companies will be around in the next 10, 20, 30 years. Those are the companies that I want to buy, right? And remember that the market is like a breathing cycle, right? It breathes in and out, right? It's like a wave. And every single dip or every single crash is always an opportunity to buy more, right? But you always buy the dip on good, stable companies. And if you don't know what to buy, then simply buy the indices, right? Because the US market makes annual gains 73% of the time, 75% of the time, right? So you can close your eyes and understand that 3/4 of the time, you're likely to make profits, okay? Now, here's a nice little infographic for you guys. These are returns by some of the top hedge funds in the world in 2021. Now, thinking that the S&P 500 returned about 26 to 28% last year, right? Just have a look at how many of these funds actually profited above or beat the benchmark, right? Think about it. Where's the cutoff here? Here, literally here, right? Anything here below this point underperformed the S&P 500. And these are all hedge funds with different strategies, okay? Some of them even made huge losses, right? Or minor losses, right? Look at the sheer amount of hedge funds that did not beat the S&P 500, but rather just tracked them on a very small deficit was these right here, right? And the high performing hedge funds were only three: Senvest, Impala, and SRS. That's it. These guys obviously did much better than everybody else, right? This should really give you a good wake-up call that you should really take a passive strategy to your investing journey, right? For those of you that have just got into the stock market, you have to really realize by now that investing is a game of patience and the patience of just buying indexes or good quality stocks and holding them for a long period of time. I've mentioned this over and over again, right? Don't try to pick the stocks if you don't know what you're doing. Now, if you want to learn how to do that, that is a completely different thing, right? That's where we step in as EGA, right? That's where we step in to teach you. We teach you how to, do the FA, do the fundamental analysis. How do you value a business? We step in to also show you how to do the technical analysis, which is, okay, how do you think about what are the right stocks to buy, first of all, right, through FA? And then the second thing would be when to buy them, right? That's TA. That's the best of both worlds. That's what we specialize in, right? We're a trading school. So, what about this coming year, right? What are we looking at? How are we even going to start to make sense of what to buy this year, right? Well, here are some secular trends for 2021 that we see happening continually, right? Defense spending to continue to increase, right? As of yesterday, we had Senate appropriators propose significant increases for defense R&D programs for fiscal year 2022, including a 12% boost to defense advanced research projects and agencies, while the White House already has put out their budget, which also shows a increase in requirement for budget for defense, okay? So defense companies that have been not really performing that well are slated to do slightly better, right? Of course. And then we also have the continued reopening of the economy with supply chokes clearing, right? Many of what is happening with the coronavirus is now slowly subsiding. Systems are starting to realize how to deal with certain variants and stuff like that. A lot of the world's population is starting to roll out an effective vaccine program. And even though the vaccine obviously doesn't prevent the virus from spreading, it lowers the chance that you would die from it, right? Which is nice, which is okay, right? And we're seeing a lot of this supply come back to normal, right? We had a semiconductor choke sometime last year. We had a lot of shipments that were stuck in ports last year. And all of these things are finally starting to clear up. And the next thing that is important is, now that the supply is starting to clear up, we need to also understand that there has been a lot of pent up consumption demand, right? With also at the same time, here's another thing, the lowest amount of debt ever recorded in the US household, with the highest amount of savings ever recorded for the past, since 2008 financial crisis. So what does that mean? That means that consumers have good spending power right now, right? And there's been a lot of consumption pent-up demand. So what do you expect? You expect a turbocharged spending in various pockets of the market, right? And we're talking about things like travel. We're talking about things like food and beverage. We're talking about things like entertainment. We're talking about things like people taking vacations, people possibly revisiting or trying to go to other places, right? We're also talking about consumer staples, right? These are all things that we are seeing as secular trends for this year and going forward into the year forward, like 2023 as well, right? Because we don't believe that travel will reopen immediately in 2022, but we do believe there's a strong chance in 2023. In fact, 2024 is when majority of airlines are expecting for travel to normalize, okay? And then, of course, not to mention the continued turbocharge of the digitization of our economy. Now, as I mentioned in our previous webinar, you have to realize that COVID didn't only just bring forth a new way to do business, it forced businesses to digitize. And a lot of businesses that were not really digitizing, they died. Straight up, they died. Let me just tell you. Like, I know of businesses that just didn't digitize and they died. And what happened is, in this economy, everything has moved to the cloud, okay? And with the cloud, there are only a few big companies that rule this market, right? And I've spoken about this. We operate in a duopoly in this business. There's only Microsoft and Amazon that rule the cloud service business. Google is a close third, but they are not as close as dominating as Amazon and Microsoft. And I'm not sure if how many of you remember this, but last year, in fact, 2020, we had forecasted that Microsoft would actually take over the cloud business more than AWS, but AWS would, obviously put up quite a bit of fight, right? Because they operate in a duopoly that concentrate on different types of businesses, right? As I've mentioned before multiple times, Amazon is more like a niche service provider. Okay, you need this. Let's do exactly this for a business. AWS is a very scalable cloud service software, but at the same time, it's very specific. It's niche. Whereas Microsoft is more for your one-click integration needs, right? A lot of small businesses or the mom and pop shops, they would go more towards Azure, which is the Microsoft cloud service. And that's the two cloud services that dominate the Western markets, right? Then don't even start talking about Chinese markets where you have Baba, you have Baidu, right? And they operate in a completely different space and in the Chinese equity market, right? So cloud technology is engulfing this world. And let me just tell you something, it's not going to stop here. This is going to become a bigger market, right? Why? Because you have now things moving into the metaverse. Where is all of this data going to be stored? Companies are not going to purchase huge data centers. It doesn't make sense. You would rather allocate all those resources to a cloud service platform, right? If you're a business, you're not going to pay millions of dollars to erect your own server farm or your own server room. Very few businesses will do that because it just costs a lot more money for maintenance and such, right? You would rather pay another company to do that, right? So the continued turbocharging of the economy is another space that I think is a strong secular trend for 2022. Now, I know many of you are going to say, oh, hey, T, what does that mean? We should go all in on NVIDIA and AMD and da-da-da-da. Okay, this is a topic for later. I will keep it for a Q&A. But remember, if somebody remembers, ask me this question about NVIDIA and AMD and why I don't think that prices will return to all-time highs so quickly. Okay, I will answer this question later. If you are curious, you can ask the question and I'll answer it later. So, recapping once again, secular trends. Household savings at multi-year highs, right? I think it's come down a little bit, by the way. We are somewhere here, but still much higher than usual, okay? R&D spending for defense, higher, right? Look at the S&P 500 EPS forecast by Goldman Sachs. We are forecasting to kind of mellow out here, right? This is the adjusted EPS forecast, but still expected to grow, right? So which means to say we're expecting companies to do better this year than last year, right? Okay. And we have been surprised by the S&P performance year after year. Trust me, I didn't expect such a strong performance from the S&P 500 this past year, but it happened. Now, obviously, I'm never going to be 100% right on these things, but remember, it is not about being right. It is about getting in at the right moments. Last year, during the dip in February and March, I bought a huge position in the market, and now in January, I have unloaded another huge position in the market, right? Does that mean that the market can't go down further? No, it doesn't mean that. Because I don't allocate all my capital in one go, right? Just like everybody who is smart, you should always allocate your capital in tranches, right? Which means to say, the market drops, I buy some. The market drops some more, I buy some more. The market drops some more, I buy some more. And you always have to add in tranches, right? And you add more when you see a bounce and the market starts moving up again, then you add more, right? So you do this kind of a, you take this kind of approach, you will never go wrong in these markets, right? So we have an EPS positive forecast for this year. We have the treasury yields expected to continue to go up. As I mentioned, my personal target for the 2022 end 10-year yield was 2%. I mentioned this on the Discord and on the live streams last time, right? And they're going to expect the Fed to continue to taper. thinking about how this economy is going to continue going forward. Now, don't take this this forecast with extreme heart. Remember, these are just forecasts, right? Goldman Sachs can change their tune within a week. Seriously, okay? And then, of course, they're targeting that by 2024, we would have a Fed funds target rate of 2.6%. That means interest rates would be at 2.6%. You know what? We'll cross that bridge when we get there. Trust me, we'll hold more webinars when we see the target rates start to increase, and we'll keep you updated on that. Now, another thing that I want to mention here, very important, is there is a very important correlation between interest rates and the stock market. Okay, many of you think, or the news would have you think, and a lot of people who speculate fear would have you think that when interest rate goes up, then the stock market prices come down, which is completely untrue, by the way, right? If you look at the statistics of the stock market, increase in interest rates are actually correlated with price increases in the stock market following the next 12 months. Which means to say that interest rates, they might artificially or temporarily suppress the prices of stocks because the market is irrational and it doesn't do things in a very rational manner. But remember that when the Fed increases interest rate, what does that mean? That actually means that the economy is strong, right? And why would they increase interest rates if the economy wasn't strong, right? So the Fed actually notes that the economy is doing strong. The unemployment rates are at acceptable levels. And that's the reason why they are tapering interest rates. They're saying, okay, this economy doesn't need so much help right now. We're starting to take off. Let's pull back on the free liquidity and let the market kind of free roll, right? So that is what is going on right now. And you need to understand this. These opportunities where we see crashes, flash crash happen like this, these are all opportunities to buy and accumulate good positions, equity in great balance sheet companies. Okay? Excellent. So, what are some defensive stocks for 2022? What should you buy? What should you look at? What should you not look at? Right? And are even stocks, even the best environment, like, are you supposed to buy stocks in this environment, or do you go to the bond market, or where do you go, right? What do you buy this year? Well, stocks are obviously still the best choice, right? How do I know that? Well, look at the 10-year bond, right? If you look at the 10-year bond, oops. If you look at the 10-year yield, right, what are we at? 1.78% or some, right? Something like that, right? And if you go look at the earnings yield of the S&P 500, which means to say you take the, instead of taking, so we have the PE ratio, right? We have something called a PE ratio. This gives you how expensive stocks are relative to valuations, right? Now, if you reverse these two, you will get something called the earnings yield, right? So earnings over price instead, right? Inverse it. And the earnings yield is roughly about 3.8% right now. Somewhere around there, right? Let's say 3.5 to 4%, right? So that means if you hold bonds, you would get 1.8% per annum. If you hold the S&P 500, the earnings from the S&P 500 will pay you 3.8%, right? And then don't forget, this includes dividend yields, right? So would you rather put your money here or here? It's quite a no-brainer, right? It's a no-brainer. You would obviously put your money in the stock market, not in the bond market right now, right? Now, the distribution of valuations, according to Morningstar, this is by Morningstar, right? So full credits to Morningstar for their distribution of valuations. I just wanted to point out a few of them. And then obviously there are some here that I have done valuations on my own. In fact, majority of these here I have valued on my own, right? I guess the only ones that I haven't really fully valued are, let me see, Alta. Tesla is a shaky one because it's difficult to value sometimes, and Home Depot, right? Only these that I haven't, done valuations on. So, having said that, with valuations, and okay, so first of all, stocks are the best thing to buy. So now, what stocks do you buy first of all, right? Well, here's the thing. Some pockets of the market remain investable, and some don't, right? There are pockets of the market that are overvalued, which is about 35 to 40% of the market, by the way. And then another 40% which is fairly valued. Now, a very small percentage of the market is undervalued. So what are some of these undervalued businesses? You will be surprised that some of these are actually leading names, right? Meta, Facebook owner, right, is undervalued right now, okay? The intrinsic valuation is somewhere closer to $400 for me, personally, my intrinsic valuation, right? Google, still undervalued. After this dip right now, massively undervalued, almost to a 20% degree, right? Amazon, this one should be a no-brainer, right? Leader in cloud services, fully diversified business. Of course, we know the pitfalls of Amazon because their main business is a loss, but AWS profits enough to cover the losses of their main business. But in the future, if they optimize their supply chain, this business will become one of the top performing businesses in the world, which, by the way, it kind of is, right? It is number 3 in market cap in NASDAQ, right? Then Baidu, Chinese stock, right? And Alibaba, this is like your Google of China, massively undervalued right now, right? They are a very strong business, by the way. Another Chinese business that I personally like is Tencent. They are like the social media dominating company in China, right? Salesforce, another one. Adobe, another one. And by the way, these are all great businesses with solid economic moats, which means to say these companies dominate the sectors that they're in. Okay, with the exception of Microsoft and Amazon being in a duopoly for the cloud-based services, right? Think about the rest of them. Meta dominates communication sector. Google dominates your technology sector in terms of ads, right? Baidu dominates also cloud services plus social media and the search sector of China. Salesforce dominates the CRM, which is customer relationship management sector, right? Adobe, tell me one person who doesn't have Adobe, right? There are very few people who don't use Adobe. Designers use Adobe. So many things. Adobe has, so many different products now that you will end up using one of them, right? And now they've moved to a subscription model too, right? Just like Microsoft did. Smart move, right? Alibaba dominating the e-commerce business and sector in China, right? So all of these are great businesses that are undervalued at the prices that they are right now. Why? Because the stock market is irrational and sold off, right? So you have to take advantage of these moments to buy exactly these stocks, right? Next, what about the overvalued businesses? Apple, yes, Apple is indeed actually a overvalued business. Now, I'm not saying that after this drop, it's super overvalued, but I would say it's still slightly overvalued to fairly overvalued. That is the range that I would look at with Apple, right? And Nvidia, despite what people think, this is now a overvalued business. There was so much of interest in these chip companies in the last year that we saw an immense amount of flow of capital towards semiconductors. Okay. Now, as I mentioned, whoever who wants to ask me about semiconductors in the chat, please do so that I can give you my 2 cents about this during the Q&A. Right. Alta, United Health, Home Depot, and of course Tesla. These are all companies that are now overvalued. Okay. So buying these companies will give you muted returns in the future. But buying these, and you hold for a 5 to 10 years period, right? You can definitely, make a decent bang for your buck. And this is very important to note, right? So welcome all 83 of you. I hope you're having a good day. Thank you for attending this webinar. You guys are awesome. Please remember to smash the like button. That would truly, truly help me out a lot. We're going to go through more things here just in a second. Right now, we're going to be going over the common mistakes that traders make, right? So here's the problem. The reality is that most traders and investors are going to lose money in the stock market. And I'll tell you why. It's simply because they just don't have a proper education system or a proper support system. A lot of that has happened in 2020 and 2021 has been absolutely horrendous, right? this is where EGA kind of steps in, right? And this is the reason why I actually started EGA, right? For a second, just humor me, right? Because I started EGA after realizing what was happening, right? There was a lot of hype-driven communities that were created around social media that started to really mislead people and what you can actually gain in the stock market, right? A lot of these traders that have just joined the stock market end up in positions where they immediately lose money because they don't know what they're doing. They don't invest in themselves, not in education, not in a support system, and it's just terrible. They end up being in a situation where they just lose all their money and then they're sad about it and they just keep going through this vicious cycle and again. And this is where I decided to step in to provide that education, right? I think that education is the most important thing when you are starting off your trading journey, right? It's just like you wouldn't go and first of all set up a business of your own without surveying your competitors, knowing everything about that market, and knowing everything there is to know about that segment or that sector, right? And many people don't realize that trading is actually like owning a business. Okay, trading is like owning a business. Then I got too excited that I threw my pen in the air. So, trading is like owning your own business, and why do I always say that? Because when you are trading, what are you actually doing? You're finding the best products to buy and sell. And the best products to buy and sell will always be around if only you can understand what is overvalued and undervalued. What is the right things to buy? It's not about what everybody is buying. Many people tend to focus on that. And then there are a bunch of people that have made, groups where they tell you what to buy. And this is the funniest thing to me, right? They call themselves signal services, and these are some glaring mistakes that traders make. I don't want to get too much into signal services, but I'll end up going on a 50-minute rant, so I don't want to do that. Let's talk about the glaring mistakes that traders make, right? Here are some of the most important ones. So, first of all, over trading. This is a huge one, okay? I want to talk about this because I think that many of you are guilty of this, and it's taken me a very long time to understand that traders don't really understand that you don't need to trade every day, okay? You don't need to trade every day. Even as a day trader, you don't need to trade every day. In market conditions such as today, in fact, I always, on our Discord community, the community that we run, which, by the way, is not a signals community, I always tell our students and our mentees, don't expect the market to give you a trade every single day. There are going to be days that you just don't trade. Why? Because the cadence of the market's not there, right? Or the secular trend is not in alignment, right? Maybe all the individual ETFs that are trading are not in alignment with the stock market. In days like that, you need to understand that just don't trade, because it's better to conserve your capital than to jump in and out of many trades at the same time and pay a ton in commission, okay? A lot of traders like to sit in front of the computer, look at charts the whole day, and hope for something to happen. Whereas professional traders understand that what this is about is just sitting there, waiting for the times of volatility, playing the volatility, and then you're out. That's it. You're done for the day. You find a few good moves. You concentrate on the setups. You concentrate on the setups the day before. You get in, you get out, and you're done. Excuse me. And many of these traders don't concentrate on the trends. Like, there are secular trends within the market, right? Where is money shifting from? Like, for example, this week, a lot of money shifted from all of the rest of the sectors into energy and some into financials ahead of the FOMC, right? And we knew this going into the week. That's what we were setting up for, right? And that's what we traded. That's the only things I traded this week. Literally two things, XLE, and I picked a very good setup on oil exploration, which was FANG, Diamondback Energy. We played these two. I didn't touch anything else. I'm remaining risk averse until the market gives me a reason to trade, right? And students who are in the Discord, they will tell you, right? If you're in the chat, you know what we traded this week, right? We only traded energy and financials. And the other thing is people get too obsessed with being right. Here's another thing. So second point, right? Which is trying to call tops and bottoms. People are so obsessed with being right that they develop this God complex. It's an ego complex. And let me tell you something. This is going to be your downfall as a trader. If you don't control this, you are absolutely going to destroy your portfolio. Because trying to find the best price to get in and ignoring the basics of risk management or the logic that you're going to need to take some risk on is easily one of the most common ways I've seen people destroy their portfolio. They think so strongly about their own trade idea that they forget about the basics of what risk management are. They have such a strong conviction of the trade because they see the MACD curling up. They see the RSI oversold. They see the moving averages pointing up. They see the, Mickey Mouse indicator pointing at the 45-degree angle and the Batman light shining into the sky, showing a bat formation. Guys, technical indicators are great to a certain degree. You need to learn to rely on them less as the time goes on, right? Rely on price action. Those are real technical indicators. What is actually happening? What is the live interaction of buyers and sellers? That is truly what we look at as technical traders, right? So don't try to call tops and bottoms. Remember that there is never a perfect time to enter. You try to remember that when you are approaching a high or a low, and if you're in a long trade, you should always exit near resistances and enter near supports. That is it. Stop trying to catch the whole wave. You're going to kill your portfolio doing that. Okay? This is another big one, right? So two things, right? This is number one, this is number two. Number three, stop loss management. Majority of traders don't set stop losses. And then here's another one. They let their trades get super red before they set a stop loss. By the way, I'm guilty of this. I do it from time to time. It happens. This week, I let it happen to me. Sorry, not this week, but a couple of weeks back, I let it happen to me. And then upon realizing that I made a mistake, I closed out those trades. But it's okay because I usually hedge my portfolio. And so those losses were far offset by gains, right? And it's just, you need to realize that keep hard stop losses except for swing trades, right? Swing trades are expected to make big losses before you see big gains, right? So what are scalp trading? What is scalp trading? What is swing trading? What is day trading? How do you get into all of these things? How do you set stop losses? We teach all of this on the mentorship course, right? The beginner course and the TA course, right? And I'm going to explain about this in a bit, right? But not moving stop losses into profits is one of the biggest mistakes that traders make. So let's say you enter here and your trade is now in profit, right? Traders set a stop loss here, but they don't move it up into profits once your trade is in a profit. Now, this is something that we teach on the mentorship course, and it's very important, okay? It's a very important skill to know. How do you move your stop losses? Especially with options, it's not straightforward, right? How do you know where that level is? How do you calculate it? How do you take that position based on where relative to other things, the stock price, etc., right? These are very important glaring mistakes that traders make, okay? Next. Ignoring risk management. This is one of the important ones as well. And boy, oh boy, do people just ignore it. Now, a lot of what has happened in the retail trading market is that traders have now started to move towards services or platforms that provide signals, okay? And don't get me wrong, this is great if you are a seasoned trader and you know what you're doing. But if you're a beginner trader, you need to first invest in your own education before you even understand how these signals work. Because a lot of these signal communities, what they do is they keep throwing you a fish every day. So it's kind of like you're addicted to drugs, right? What does that mean? Every day there is idea thrown at you, and it's pretty much like, okay, I'm gonna enter here and I'm gonna exit here, right? But you need to realize that this is pretty much like the equivalent of cheating on an exam, right? And hoping that the teacher just doesn't catch you, right? The worst part is you're not learning anything, so you're relying on somebody else to do well on the exam. Eventually, you're gonna get caught by the teacher. That's my point, right? The stock market is gonna be the one to call you out, because by them telling you where to buy, or where they have bought and where they have sold, it only does one thing. It only allows you to see where they have entered and where they have sold. It doesn't give you the idea behind the trade, why they're taking it, the credibility of that person. It doesn't show you what was the overarching risk management strategy that they used, how much risk they put on, right? It's really easy for people to post 10,000, 20,000, 30,000 profits per day, okay? And there are people in the market that do that. There are people who even post 100,000 profits per day, right? Very famous traders. But you need to realize how much of risk they're taking on, okay? And if you can tell me that you take on $100,000 profit without putting on at least $1 million, you have got to be kidding me, right? Because that would be a 10% return, right? On your $1 million investment, all right? So the question becomes, are these people really using risk management? Then this is my point. This is my point, right? So I keep it very simple. With whatever things that we do at EGA, we use the same risk management regardless of whether my portfolio grows or is lower. We use the same risk management because that is the way to build consistent wealth, right? We keep it same all the time. Each trade is between 3 to 5% in risk, and we don't risk more than that, right? If there is a high conviction trade, I may go up to 10%, but this is only for a scalp or a day trade, right? I will never swing something with a 10% risk, right? That's a very rare thing to happen. Okay. So these signal services, they're great to build clout. They're great to show you oh, here's my profits. But then in the background, you don't know how much this person has risk, and it's unrealistic, number one. Number two, you start to see the cracks roll through when their risk management style just breaks down when the market comes down, right? That's all. The rest is up for you to debate in your own head, right? Lastly, here is one of the bigger ones. Relying too much on one style. This market has become an extremely polarized market. And I find it really funny that we have people that are so concentrated on fundamentals now, and then people who are extremely concentrated on TA now. And they both don't know that you need both these skills to survive in this market. Because fundamental analysis tells you what to buy, so you need to learn how to value a business, right? And then technical analysis tells you when to buy it, when things are retracing back to moving averages, when things are retracing back to multi-year lows, or things are retracing back to specific supply and demand levels, right? So don't rely too much on one style. You need to learn all of it, okay? Now, this is very important, because if you don't, then, it would be very difficult for you to make it in this market, okay? It's simple as that. Okay. So, this is exactly where EGA comes in, right? This is where we come in. What do we provide? What do we do? How do we step into this realm, right? We provide trading education and mentorship programs that pretty much don't make you reliant on feeding you with signals, right? Most importantly, I think one of the important things about EGA is that we provide one-on-one coaching sessions. That means you do the one-on-ones with me directly, right? And live trading sessions during market hours. Just a show of hands, how many of you are from the Discord community on this live right now? And how many of you have been enjoying the benefits of the live trading session in this past 1 year that EGA has been incepted? I would love to hear from you so that the rest of our lovely trading community can also understand your journey, right? The best testimonials come from the people who are using the service, right? And I think that is extremely important. So the live trading sessions changed the game entirely, because I think that having somebody to guide you there through market hours and giving the perspective from how things happen from start to finish and the formulation of a trade idea is completely game changing, right? You can't fake that. In addition to that, all of our trades are logged. All of our trades are validated on a weekly basis, right? I post the P&L from every single trade. These are all things that validate everything that we do, right? So how does the progression of each student work through in EGA? Well, majority of people start at the beginner's course, and this is the most basic level that will give you an overview of trading strategies, risk management, right? Options, and fundamental valuations. We go through TA, but it's a very small introduction into TA. Then, majority of traders who want to personify their learning process and fall more into the day trading category, they move into the technical analysis course. This is where you master price action. This is where you look at scalping, day trading, level 2 data. This is where you learn about how market makers interact, right? Then you can go on with your journey with advanced option strategies if you want to learn further. And all levels of traders are welcome on our Discord community, which you will be able to find on our website, learncompoundgrow.com. Okay. Now, the live trading sessions look like a log of all of our trades. Now, the other thing is, every single week, we absolutely log every single trade that we have taken on an Excel sheet, and I post that Excel sheet because it's needed for transparency, which means to say everything that I call out in the live or everything that I call out in the channels are posted. Even if it's a loss, we post it. Even if it's anything that we have gone wrong, we post it, because that is how we learn. Okay. So, for example, last week, this was the profit and loss statement from the entire week. It was a very a busy week, right? And it's not like it was all gains. Remember, some of them are losses too, right? We had some losses here, but remember that as long as your gains are more than your losses, that is something that you will always be able to outwin, right? And the live trading sessions are also very important because you can ask questions whenever you need, right? A lot of students enjoy the live trading sessions because when you come into the live trading session, you can actually understand my thought process, right? Why am I taking this trade? Why is this happening, etc., right? And of course, we're enrolling right now for the TA and beginners course, right? For those of you that don't know, this is going to be a 5-day and 6-day course, respectively, right? Monday, February 7th to 11th of February will be the beginners course, and then 21st of February to 26th of February for the TA course. Awesome. I joined the course bundle and can't wait. Oh, awesome. Lama, we will see you in class. Excellent to have you there. Been a member since wave 9. Nice. So, just a couple of things about the classes. They're all live. That means you will be interacting with me live on Zoom. They're about 2 to 3 hours long, each class. We will be using real world scenarios. Those of you that have sat through EGA mentorship course before, every single wave is different. There is no wave that is the same. Once you buy one of the courses, they're lifetime access, so which means to say you have lifetime access to recordings, and you can also join future waves for lifetime. Okay. And here are the differences between both the courses. As I mentioned earlier, in the beginner course, you learn about how the stock market works, the complete guide to options trading, which is very important. We don't teach options trading except for in the beginner's course. And then learn different types of strategies. We master those strategies in the technical analysis course. And then, of course, fundamental analysis in the beginner's course. In the TA course, we concentrate more on price action. We concentrate on market maker activity. We concentrate on chart patterns and also Fibonacci's, reversal trading. How do you analyze level 2 data? These are all the things that we go through in these courses. So right now, since we are at the end of the webinar, I wanted to do a special webinar special for all of the people who are watching. If you are interested in taking this course, just as a thank you for attending this webinar, by the way, this deal is not going to be available to everybody. It's only people who are attending this webinar. For the people who are attending this webinar, you can use EGA 20 off. Remember, it's cap sensitive, or EGA 30 off. EGA 20 off will give you 20% off individual courses. So the beginner course will be at $390 and the TA course will be at $430. And the bundle, you can use EGA 30 off to get 30% off the bundle price, which will bring your two courses combination to $718. Okay. This will be the special promo that we're running only for the next 24 hours. So make sure that you use the codes within the next 24 hours. The codes are now live. I've just made them live before the webinar. So you should be able to get these deals sorted right now, okay? We hope to see you in the courses, and we hope to obviously have you a part of the EGA tribe. And I think that, some of these testimonials that I'm about to show you should really, bring it home for you guys. What are the timings of the classes? They're going to be 9 p.m. EST and 6 p.m. Pacific time. So 6 p.m. Pacific time or 9 p.m. Eastern time, and usually about 2 to 3 hours. Just so you know, bonuses, all the courses come with 2 60-minute one-on-one private sessions with me, okay? 2 months access to the Discord community for free for the bundle, okay? And weekly live trading sessions. So we live trade almost every other day. So, I think we've been live trading every day now for almost a month or so, more than a month. I don't know. It's been countless number of months, right? So these are just some bonuses, right? Including, we also have the indicator setup that we use. This is another thing that we provide, bonus. A trade optimizer and a risk to reward ratio calculator. I will also be giving you the company valuation template, which will be the DCF model for you to use to calculate your own valuation for businesses. And then the Fibonacci cheat sheet, which will be included with the Fibonacci lesson during the TA course. So these are all bonuses that you'll be getting if you join some of the mentorship courses, right? Here are some testimonials from alumni. I like to read some of these out because I think they are excellent testaments to how we deal with our students and how our students view us from the outside, right? So Jonathan Savage, I think, was one of our students, in the previous wave. I've been toying with the idea of taking this course for a few months, and the only regret is I did not do it sooner. There is so much material out there, and even in other courses, but not many seem to be live and in real time with the market conditions, which makes a huge difference. T explains his own methods and what most relevant information is, as well as what to really focus on. No fluff. Small class size also ensures that we don't continue. We don't continue until everyone understands the concept. So it's a pleasure taking part, and I look forward to keep learning with you all. This is very true. The small class size really does make sure that we don't leave anybody behind. It's a very important part of our mentorship courses. APD said, take the courses. I came across EGA last year, purchased a beginners and course, but did not fully grasp it because I was taking the biggest exam of my career. I've been through ups and downs of the market, decided to get back to the foundation and purchased a TA course recently. I rewatched both courses together and everything has clicked in place and made more sense. I truly appreciate the entire system because you can see everything that he teaches to be applied on a day-to-day basis. The YouTube videos are also a plus. I've been paper trading and fine-tuning a system that works for me and my schedule. Look forward to the continuation of my trading career. Malik, who is one of our very veteran members in our Discord, said, this is a testimonial for the one-on-one. Just had my first one-on-one with T, and I was very relieved that he was able to identify my exact issue spot on and give me solid direction. My preferred style of trading is scalping, and was starting to feel like I maybe should double into swings since I kept hitting roadblocks in my scalping. But he reminded me to practice one thing 1,000 times rather than 1,000 times, 1,000 things one time. A complete 180 from what I was thinking. I also asked for some book recommendations and got about 5, so I'll be looking to read one of those until the next one-on-one session, challenging myself to finish at least 3 of them by then. I would also highly recommend anyone who hasn't scheduled a meeting with him to do so ASAP if you are currently struggling in the dark like I was. Now I'm actually looking forward to the next one-on-one. See, this is another thing that I really truly find fulfilling. I think that a lot of traders struggle in the dark, and it's really important that you don't. And here is my reach out to you. Everybody who, even if you can't afford the mentorship courses, you can't afford anything that we provide, reach out to me on Instagram. I reply my DMs. I absolutely reply all of them. And it is no problem if you have questions and you need me to help you to a certain degree, right? Obviously, I'm not going to go in and jump in and do an entire portfolio consultation because that actually takes a lot of my time. But if you have basic questions, I always answer them, okay? So ask, don't be afraid to DM me on Instagram ever. Here's Dhruv, who's also one of our yearly members. Just had my first one-on-one with T, and it was very relieving that he was able to identify my exact issue spot on and give me some solid direction. Focus on efficiency, not frequency. He helped me orientate my portfolio. So that's another thing that I do during the one-on-ones is if you have a portfolio, I can tell you what direction to take with it, what you should reduce, what you should increase, right? Based on your own risk tolerance, right? And that's all I have for you guys. So remember that today's live webinar comes with 2 offers. EJ 20 off and EJ 30 off. Remember, these are case sensitive. And we hope to see you in the next webinar. I hope that the next webinar will be sometime in the next 1 to 2 months. Remember that in February, we will be holding the mentorship courses, so we hope to see you in class. And now I'm going to open the floor up to Q&As. So if you have any Q&As, make sure, if you have any questions, make sure that you put it out here so that I can answer them. So I'm going to take all the questions that you have right now. Okay. So will this video be available for viewing later? Yes, it will, but with a delay. We will be only putting this video out sometime next week, I believe, because we want the offer to be only for people who have attended the webinar. So if you watch the webinar and you're here live, you know about the offer. If you don't, then the video is only going to be posted sometime next week, but by that time the offer will lapse. So we want to be fair to provide this deal only for people who are here at the webinar. Okay. T, how do you see geopolitics affecting the market, Russia, Ukraine? To be honest, I don't really look much at those things, but I do think that irregardless of all of these things, I think that you shouldn't look at it from the standpoint of just Russia and Ukraine. Think about what are the macro situations and what are the markets that will be driven by the perception of war, which is energy, and then currencies, right? So if you're not a Forex trader, then this would not really make sense. But people tend to move towards very specific things during perception of war. One is energy stocks, which is oil and gas exploration. And then, of course, currency pairs that are favoring the currency that is more stable, right? Surprised to see Apple in overvalued. Its PE is less than 20. PE is less than 30. Remember that PE is not everything, guys. The price to earnings only dictates how expensive it is relative to earnings. Remember, there's also something called the PEG ratio, which is the price over the earnings growth, right? So go look at Apple's PEG ratio to understand why it is overvalued. Is AMD also overvalued along with NVIDIA? Yes, it is. If you all remember, about, let's say a year and a half back, we spoke about semiconductors, the semiconductor market and how it's cyclical, right? Remember that the semiconductor market goes through booms and busts, right? Why? Because semiconductors tend to operate in a market where there's over demand and oversupply at 2 specific points. We were in a position where semiconductors were super cheap during the COVID crisis and there was pent-up demand. Then demand started to catch up now, and this is where we are now, right? We are somewhere here. And semiconductor prices have now come down to where they are now, and the supply chokes are now starting to clear up. So you need to remember that this cycle will continue to go on, and then semiconductors will get cheap again, and then that's when we will go in and buy the dip on irrationality once again, right? Okay. You talked about buying the dip. What about buying in the dip, but what about when to sell off? Do we sell off when we see profits, or we hold longer? What's your advice? Okay, so if you are an investor and you are planning to invest your money in the stock market for the long run, then your strategy should be hold forever, right? If a stock is a great stock and you expect it to continue building wealth for you, then the best holding period is forever, until your retirement, right? So irregardless of what short-term price action happens, you should always hold investments into perpetuity. That is the idea. You don't sell stocks and buy them back. This is one of the worst things that people do, is they buy a stock low and then it goes up and then they sell it high, and then they try to time the bottom again and then they buy it back and then they go up and then sell it again, buy it and sell it and buy it and sell it and buy it and sell it. Let me tell you something, okay? Here is the part which will shock you. Buying it here and holding it into perpetuity will return you much more than you doing this bullshit of you buying and selling and buying and selling and buying and selling. You don't believe me? Go look at the cumulative returns on Amazon versus somebody who had calculated if you would have bought every dip and sold every rally on Amazon, what would happen? Okay? The difference is astronomical. The compounding returns are astronomical. Okay? I wonder if Powell is just stalling the inevitable. If the inevitable you're talking about here is the fact that the bond market's going to blow up, then I will tell you that it's a very low chance that the bond market will blow up. But what might happen is inflation may run higher than usual for a prolonged period of time, like longer than the Fed is expecting. And I don't think that the Fed will be very, very aggressive with their monetary policy this coming year. Okay, I think they will take it a step at a time, just like how Powell has done it. The problem is the market tends to overreact. Oh no, interest rate hike, and then boom, everybody starts to sell. And that selling creates cascading effects because everything is algo driven now, right? So that's why the drop has happened, right? You talk about, okay, then what do you think about future of health sector like Moderna or Pfizer? We see COVID with vaccine is slowing down. What does that mean to these companies? Okay, good question. If you're talking about those individual two stocks, no one can predict what's going to happen to Moderna and Pfizer. But I personally think, let me just tell you that in these environments, in an inflationary environment coupled with high interest rates, healthcare sector tends to outperform. Okay? Because irregardless of whether goods and services rise, people still get sick. So irregardless of what happens in the stock market, people still need to see doctors, people still need to go and get medicine, and people still need to go and get vaccines. So healthcare sector tends to outperform in this kind of market condition. It's one of the secular trends we're looking at for this year. This is what worst happening to me when it's growing. I usually get exit with small profit and hold when it's losing. Yeah, so this is one of the problems that traders face, right? You tend to get in at the wrong time. That's the problem, my guy. The problem with you is you see a stock going up and then you start to buy it when it's starting to go up. And then you start to see, oh, when it's going up, and this is where you enter. And then when you enter, you take profits after you see a little bit of entry, or you see a little bit of profits, you start taking it. Or you enter here and then immediately this thing goes down. And then you don't buy it here. Why? Because it's red, and then you are anticipating for it to go down further. And then it goes boom, right? Trust me, this is the beginner problems that you face, and I sympathize with it. I understand what you're going through. I highly recommend you to consider being a part of the beginner course. It will help you to fix these problems. Remember that the market moves in waves, and so it's too much for me to talk about in one session over this live right now. But I can tell you that one of the biggest problems here is your timing of entry. I know exactly what your problem is. It's the timing of your entry. Dollar cost averaging, so simple, but many people don't do it. Exactly, right? Keep buying the same thing over and over every month. How do we know when to sell? This happens with me as well. Buying, selling continues. I understand. Gem Savory, I sympathize with that. How do we know when to sell? I always face this issue. It kind of depends on, are you talking about options or are you talking about stocks? Personally, if I buy equity or stocks, I will hold it forever. So my investment strategy is, if I buy something, I'm going to buy it to hold it into perpetuity. I don't buy it to ever sell it. That's my my philosophy of investing, right? I'm a fundamental investor. So what happens is, I value the stock, and I only buy the stock when it's undervalued, right? So I will only buy the undervalued companies, and my favorite holding period is forever. Until then, whenever the stock is undervalued, I will continue to dollar cost average whenever the stock retraces back to moving averages. So that is the best strategy that you can possibly take. You just don't sell your equity. If you're talking about options, there are many different strategies for options. Too much to go over right now in this live, but you know what? Take the TA course or take the beginners course. One of in both of them we go through the right strategies to exit profitably on options. Also, if you don't want to take the course for whatever reason, DM me on Instagram, right? Remember, whichever way, I'm here to help you. It doesn't matter whether if you want to take the course or not. The point is, I'm here to help you, okay? Because options are very different from equities, right? They behave in a completely different environment, and there's time value associated with it, and you have the Greeks and so on and so forth, right? So we can't view them on the same level. Let's see. What do you think about FOMC today? So Powell had a very similar tone to what he has held. I didn't see his report to be much more hawkish than what everyone was expecting. In fact, I think that the market dropped on this news even further. But from the technical standpoint, it seems to me that the market is still overreacting. Right? So add on the dips in specific tranches. I've added almost 3/4 of my positions, and I have 1/4 more to add, and that will happen when only and if only I see the market start to reverse, right? So dollar cost average into your positions. Thanks. That makes so much sense. Thanks. No problem. UDS Van Gran. No problem at all. I'm not a career trader. Only trade on my own personal time. How will TA benefit me? So if you don't want to become a day trader, if you want to just rely on kind of passively trading, then here's the thing. It's like you can be one of those traders that are only around for 1 to 2 hours a day and make a killing, right? That's kind of like what I do. I'm not there in front of a computer the whole day. Why? Because I have other things to do, right, with my life. In addition to EGA, I run the entire school. I have other side hustles that I run as well, right? And so a lot of my energy is focused on other things as well. So what you should understand is TA benefits you by understanding when you should buy those long-term investments, right? Understanding how market participants are interacting with the market is equally important as fundamental analysis on how to value businesses. So TA is important to that degree. I highly recommend you still concentrating some of your efforts on TA, because it will allow you to tell when things are retracing back in terms of your rationality, right? Best stocks of 2022 to pick on the dip. Were you here a couple of minutes ago? I went through this. We went through it in the discussion on the webinar right here. These are the best ones in my opinion right now. Meta, Amazon, Salesforce, Alibaba, Google, Baidu, Adobe, Microsoft. These are very strong companies, extremely strong. If you want to take on some risk, go pick up some ARK fund, right? Okay, then we have okay, so I'll answer all of these and then we're done. I'm going to stop at Maffei and then we will stop and then we'll end the live session here because it's going to approach 2 hours now. Tell us more about China. What do you see? Do we put more in Chinese market these days? Okay, so good question, but I'm not going to answer your question right now. I wanted to cover China in this webinar. That was the truth and the reality. But let me tell you the problem. It is way too big of a topic to cover in this webinar. I'm going to hold another webinar that is going to be catered, or I will do a YouTube video that will give you guys a better understanding of where the Chinese stock market is. And I will try to put out that video by the, let's say, the end of this next 2 weeks. Okay. If you want a quick summary, Chinese equities are very well priced right now, and in my opinion, the Chinese stock market will outperform the US stock market this year. This is my take. Summary. Okay. Thanks to Tushall. No problem, Gem Savory. No worries at all. TA and reading financial reports should be the foundation. Absolutely. Is VOO a good price to buy in now? Absolutely. A suggestion is to have a webinar specifically on options and its characteristics. That will be gone through in the beginner's course. By the way, we already have a free webinar that you can watch as part of our playlists. For those of you that do not know, our YouTube channel is a repertoire of extreme information. I don't know if you guys know this, but under playlists on our channel, if you go click on growth webinars, you will literally be able to find a whole bunch of things here. Oh, sorry. Wait a minute. Yeah. You'll find a whole bunch of things here. Let's see. Where's the options one? Did I not increase one? Huh. Oh, I know where it is. Oh, it's a hidden video. That's why. Sorry. I understand. I remember what happened now. We have that video as part of our Discord. It is one of the parts that we offer as the Discord premium video. So having the Discord subscription would also lead you to having access to some of these special webinars that I hold. Will there be a high probability of a bear market when the tapering starts this year? Historically, if we talk statistically, no. But anything can happen, right? So statistically, no, but anything can happen. That's my reply to that. If you ask me my opinion, I say no, because I think the economy is very strong. I think the stock market is going to be a reflection of the economy in the next 6 to 8 months. So yeah. All right, excellent. One last time, if you didn't see the codes and you want to take advantage of the deal, I said the bundle is the best deal. Obviously, you get 2 courses for a much lower price. I hope to see you in class. We'll hold another webinar soon. I hope you guys have a great day, a great rest of your week, and I hope you enjoyed it. If you did, make sure you smash the like button on your way out. And I love you guys, so take care, and I'll see y'all on the next one. Peace.